The hidden architecture behind European money. It doesn't live in vaults. It doesn't move through branches. It exists in systems most people never see. To understand how European banking really works today, you have to look beneath the surface, not at logos or interest rates or national balance sheets, but at the architecture that quietly connects every institution, every market, and every transaction across the continent. Because modern banking is no longer built around places. It's built around pipes. For decades, money moved slowly. Payments took days. Settlements were local. Banks relied on physical presence and national clearing systems. Control came from geography, and distance created friction. Then technology changed the rules. Digital settlement systems allowed money to move instantly across borders. Central banks connected their platforms. Interbank markets synchronized. What once required coordination now happened automatically in milliseconds. Europe didn't just integrate banks. It integrated infrastructure. At the center of this architecture sit payment systems, clearinghouses, and settlement platforms. They determine how money flows, when obligations are met, and who carries risk at each moment. They are neutral in appearance, but decisive in function, because whoever controls the infrastructure controls stability. Banks no longer settle accounts individually. They rely on shared systems to net positions, manage collateral, and access liquidity. This reduces costs and increases speed. But it also creates dependency. A disruption in infrastructure affects everyone at once, and most of this remains invisible. Customers see balances update instantly. Transfers clear smoothly. Markets appear liquid and efficient. Few realize how many layers of coordination sit behind a single transaction. These systems became the backbone of trust. They ensured payments would settle even if counterparties failed. They allowed banks to lend to each other without knowing each other personally. They replaced relationships with rules and judgment with automation. At first, this felt like progress. Risk seemed contained within the system itself. Safeguards were built in. Collateral requirements adjusted automatically. Failures could be absorbed without panic. But architecture shapes behavior. Once money could move without friction, scale became easier. Banks expanded faster. Positions grew larger. Exposure multiplied. The infrastructure enabled growth, but it also enabled concentration. And quietly, Europe's financial system began to rely on mechanisms that few outside the industry truly understood. That hidden architecture would hold everything together until the moment it was asked to do too much. As the architecture expanded, so did its importance. Clearing systems began to replace trust between institutions. Instead of relying on counterparties directly, banks relied on platforms to guarantee settlement. Risk was no longer managed relationship by relationship. It was pooled, standardized, and automated. This made the system faster. It also made it more brittle, because centralization changes failure dynamics. When processes are dispersed, mistakes remain local. When they are centralized, errors travel instantly. A delay, a mispricing, or a technical failure no longer affects one institution. It affects everyone connected to the network. Europe accepted this trade-off quietly. Efficiency mattered. Speed mattered. Cost reduction mattered. And as long as markets were calm, the architecture appeared flawless. Payments cleared. Collateral adjusted. Obligations netted smoothly at the end of each day. But calm masked dependency. Banks structured their operations around continuous access to these systems. Liquidity planning assumed uninterrupted settlement. Risk models assumed infrastructure would always function as designed. Contingency became theoretical. Few institutions maintained meaningful alternatives. Backup systems existed, but were rarely tested under real stress. Redundancy looked expensive in a world optimized for margins. Then pressure began to rise. Volatility increased. Collateral values fluctuated faster. Margin calls arrived earlier and more frequently. Systems designed for efficiency now demanded speed under stress, forcing banks to react in real time. Small delays had consequences. A missed settlement triggered penalties. A delayed payment raised questions. Questions turned into caution. Caution turned into withdrawal. Liquidity tightened not because assets vanished, but because access slowed. Infrastructure did not fail. It amplified behavior. The architecture did exactly what it was built to do. It enforced rules relentlessly. It demanded collateral without emotion. It treated all participants equally, regardless of circumstances. And in doing so, it removed discretion. There was no room for judgment, no pause for context. When thresholds were breached, responses were automatic. Stability depended not on understanding, but on compliance. This was the hidden tension. Systems designed to eliminate human risk also eliminated human flexibility. And when markets moved faster than models predicted, that rigidity became a source of strain. Europe had built an architecture that assumed normal conditions. It had not fully prepared it for abnormal ones. And the more the system relied on those invisible pipes, the harder it became to slow things down when it mattered most. When stress reached its peak, the architecture was exposed. Settlement systems demanded collateral just as asset values fell. Clearing houses recalculated risk daily, sometimes hourly. Margin requirements surged at the worst possible moment, forcing banks to find liquidity precisely when it was disappearing. The system did not panic. It enforced. Banks scrambled to meet obligations. Assets were sold quickly, often at depressed prices. Fire sales pushed valuations lower, triggering even higher margin calls. What began as protection turned into acceleration. This was the feedback loop nobody planned for. Infrastructure that was meant to absorb shocks instead transmitted them. The faster it operated, the faster pressure spread. Automation removed hesitation, but also removed restraint. Central banks stepped in. They injected liquidity directly into the system. They widened collateral eligibility. They extended operating hours, not to rescue individual banks, but to stabilize the architecture itself. Because if the pipes failed, everything downstream would freeze. These interventions were unprecedented. Central banks were no longer just guardians of money. They became guardians of infrastructure. Payment systems, settlement platforms, and clearing mechanisms became matters of financial security, not just efficiency. This changed how risk was understood. Stability was no longer about balance sheets alone. It depended on how systems interacted under stress, on timing, thresholds, and design choices that once seemed technical and harmless. Europe learned that architecture is policy. Every rule embedded in infrastructure carries consequences. Every automated response shapes behavior. Neutral systems are never truly neutral when pressure rises. After the crisis, scrutiny intensified. Stress tests expanded beyond banks to include infrastructure. Scenario planning considered system-wide reactions. Redundancy regained value. Slowing mechanisms were discussed not as inefficiencies, but as safeguards. The goal shifted from speed to resilience. Europe did not dismantle its financial architecture. It strengthened it. But the illusion of invisibility was gone. The pipes were now recognized as pillars. Because when everything depends on systems you cannot see, their design becomes a difference between stability and collapse. And that realization changed how European money would move forever. Out of the crisis came a quieter transformation. Europe did not abandon its financial infrastructure. It refined it. Rules were adjusted to slow extreme reactions. Margin models became less procyclical. Safeguards were introduced to prevent automatic spirals during stress. The goal was balance. Systems still needed to be fast, but they also needed to pause, to absorb shocks without amplifying them, to recognize that markets behave differently under pressure than on spreadsheets. This changed how stability was defined. Resilience was no longer about eliminating failure. It was about managing it, allowing systems to bend without breaking, designing architecture that acknowledged uncertainty instead of denying it. Central banks remained at the center. Their role expanded beyond interest rates and liquidity. They became overseers of the invisible machinery that keeps money moving. Coordination between institutions deepened. Infrastructure was treated as a shared responsibility, not a neutral backdrop. Banks adapted as well. They built buffers not just in capital, but in operations. They planned for delays. They tested contingencies. Dependency was no longer ignored. It was measured, yet the lesson lingered. Most people still never see this architecture. Payments feel instant. Transfers feel effortless. The system appears smooth, almost natural. But beneath that simplicity lies a complex framework shaped by past stress. Every silent settlement carries memory. Every automated process reflects a compromise. Every safeguard exists because something once failed. European money moves faster today than ever before, but it also moves more carefully because the continent learned that stability is not just about trust in institutions. It is about trust in the systems that connect them. And those systems are only as strong as the assumptions built into them. So what do you think? Are we repeating the same mistake again? The hidden